Real estate is a favorite investment topic both for the resident Indians as well as the NRI community. Of late, lot of changes have happened in the real estate space. Enactment of RERA laws, changes into the tax laws and several other things make real estate a topic to study before you venture into this. In this topic today, we are going to talk about all the things the NRI community need to know before they buy property in India. To bring to you all the things that are happening on the ground in the real estate space, we have amidst us our guest faculty, Sri Mr. D B Mehta. This is Dr. Chandrakant, but for you in NRI Money Clinic, I am an investment consultant and a financial planner.
NRI Money Clinic. No hype, just the right advice.
To talk to you about the real estate issues, how to buy properties and how to sell properties and every aspect of the real estate that you need to know, we have a very eminent faculty today in our studios. Mr. D B Mehta, you are already familiar to him. He had done one another video earlier. But for those who have not watched this video, I will be reintroducing again D B Mehta to you all. Mr. D B Mehta comes with rich experience of real estate, business, administration and several other fields. He is a chartered accountant by profession, retired IRS officer of Government of India. He served for Government of India as Deputy Commissioner of GST and Customs before he quit to pursue his other interests. He has promoted a venture called Allegro Builders to promote real estate both in Bangalore as well as Bangalore. He has also experience in the financial field, in the automobile dealership, in public administration. He has served as chairman of Mangalore Stock Exchange. He is a independent director of Smart City project of City of Mangalore. Welcome to this show, Mr. D B Mehta, sir.
Thank you.
Sir, this real estate is going through a complete shift. In our last video, you mentioned about the enactment of RERA law. Now, I just want to inform our viewers, is the property buying in by NRIs, is it same as that of the resident Indians or is there a different process for all this?
If you look at it from the regulations viewpoint, barring a few precautions to be taken, is virtually the same. Now, what are the precautions you have to take when you are an NRI purchaser? A, you cannot buy certain types of properties. You are free to buy residential, commercial and developed plots, but you are not allowed as per the RBI laws to buy agriculture land, farmhouse or plantations. The second precaution you have to take is, if you want to repatriate your money whenever you sell that property, then you better invest the property from inward remittances through either your NRE account or NRO account. And if you are investing through the local funds, then you can still repatriate your money, but it will be under a different scheme.
You said that NRIs cannot buy specific types of properties, the agricultural land, farmhouse and other things. But before they buy the property, will the builders or the seller will inform them whether this is something which is available for NRIs or it is not available for NRIs? How will they know what is that they can buy or what is that they cannot buy?
See, builders at times do not inform because they may not be aware that the person their office is dealing with is an NRI. So, it is up to the NRI to take those precautions and consult an advocate to guide them to buy the right kind of properties.
When NRIs buy property, they obviously will be taking loans. Will the loans be made available for NRIs to buy property in India? If yes, what is the process which is involved? If there are restrictions, what are the kind of restrictions that are there? Many a times our NRIs live outside of India, they cannot come here to buy, sign the papers and do all the paperwork. Is there a way, sitting in some other country, can they still buy the properties and go ahead with the paperwork?
See, there are a couple of questions merged into one, so I will break them into different issues. Number one, The NRI who is not able to come to India to buy the property should execute a power of attorney in favor of a relation preferably, and that power of attorney should be a registered power of attorney. When we say registered means you have to execute in front of the registrar of stamps in a particular city or a district, and to see that the specific purpose power of attorney is given to only buy the properties, because we have instances where POAs have been misused. So, those precautions have to be taken.
Okay. So, one word of caution for NRIs is you have to be very, very careful when you give power of attorney. Power of attorney should be specific purpose of buying the property, and it should be ensured that it cannot be misutilized for some other purpose.
Now, somebody may have a doubt that if I can come to India to register a POA, I can as well come to India to buy the property and register in his name. You don't have to come to India to register a POA.
Oh.
POA can be signed before the embassy. It can be sent back to India. In India, there is a procedure called adjudication of the POA signed in the foreign country, and that adjudication process is very, very simple. The sub registrar adjudicates it. It takes only maximum 1 or 2 days to get the document back, and the cost is also very, very low. I think the total stamp duty including penalties and all is only 1,200 rupees.
Oh.
So, you need not come to India to register a POA.
Okay. But how can they avail loan in India to buy the property if they are staying outside of India? What is the process involved here?
Now, to avail a loan, let us understand, there are no restrictions on how many houses you can avail a loan. Being an NRI or being a resident Indian, there are no restrictions.
Okay.
You can avail a housing loan on multiple houses at the same time, provided you have sufficient income to service all your loans. So, that's point 1. Point 2 is banks will ask for certain documents to verify your status as a NRI, B, your income, that is your job visa, your passport copy, your salary slip, your bank account in the country where you are staying and working, plus your bank account within the country, and they will need one guarantor within India. So, that guarantor can be your relation or can be your family member. No documents are asked for from the guarantor. He has to only sign as a guarantor and should be a known person to you.
When you say guarantor, it is not a personal guarantee, it is a guarantor for the loan.
For the loan. Someone in India, because for a simple reason, if tomorrow you default on your loan payment and you are residing in some foreign country, how is the bank going to recover your money?
Okay.
Then it has to become an international issue. You have to go to the embassy. There has to be a agreement between that country where you can get the money back. So, for those purposes, a local guarantor has to sign the documents. Again, the bank also would ask you to execute a POA if you are not coming to India to sign the loan agreement with the bank.
Okay.
So, that also can be executed abroad. You need not come to India.
Okay.
So,
the same process what
the
you
same
told
process has to be followed. Bank will have its own draft for the POA. Based on that draft, you have to take a printout there, sign it before the embassy and send it back to India for its adjudication.
So, to that extent it is pretty simple.
It is pretty simple.
It's only the question of finding a guarantor, and that's the one question that you always.
Yeah, some family member has to stand by.
Okay, fine. Now, the NRIs buy this property not with the intention of coming back and staying there. It's not a need based property. They could be buying this property with an intention of investment purpose. I'll sell it for a consideration higher than what I have purchased a few years down the line or a couple of decades down the line. Once they buy the property, are there any restrictions for the NRIs to sell this property, or can they simply sell it whenever they want and they can repatriate the money? What's the process involved in this?
See, there are no restrictions on selling the property by NRI, but the NRI has to wait for a minimum period of 2 years from the date the sale deed is registered in his favor and the possession of the property is handed over to him. because if he waits for 2 years and thereafter he sells, the tax liability is less, because then you fall under the long term capital gains tax bracket. But if you sell within 2 years, then you have to pay the regular income tax, which is on a higher side. So, that is one thing that timing has to be taken care of.
Okay.
The second aspect is, if you are not going to occupy your property, you can rent it out. There are no restrictions in renting out your property, and you are allowed to repatriate the rental amount also.
Okay.
There is no restriction on repatriation of rental amount. Only thing is that the rent amount has to be directly deposited in the NRO account.
Okay.
So, you have to just give instructions to your tenant to directly deposit the amount in NRO account rather than in a local saving banks account.
Okay.
Then repatriation is very easy.
Okay. So, when they have to repatriate this money from NRO account, probably they have to shift this money from NRO account to NRE account, and probably a chartered accountant certificate could be required for filing the tax returns here, because it becomes the resident income of a overseas.
No, now let us understand, when you are selling the property, there is a different tax implication. When you are renting out the property, there is a different tax implication.
Okay.
Now, when you are renting out the property, the rent income is considered to be income earned in India.
Okay.
So, for that, if your rental income is exceeding the minimum taxable limit within India,
Okay.
then you have to file return of income tax for those years, wherever your rental income exceeds the minimum tax amount. Now, for that, you may have to hire a chartered accountant services, and it's a simple income tax return that can be uploaded. But when you are selling the property, that time there are many more precautions you have to take.
Okay.
So, like when you are selling the property, you may be selling a property to the resident Indian, or you may be selling the property to a non-resident Indian.
Okay. Yes.
So, again the implications are different. If you are selling the property to a resident Indian, the resident Indian will deduct a TDS of only 0.75%.
That's for the resident Indian. If you
Resident.
sell it to a resident Indian, TDS applicable is 0.75.
Yeah. So, the way it is looked at is, see, there are different sections. One is section 194(1)(a). Now, section 194(1)(a) is applicable only between resident Indian and resident Indian. It is 0.75. But if it is a NRI and a resident Indian has to deduct tax based on your nature of your property, whether it is long term, which is more than 2 years, or it is short term, which is less than 2 years.
You mean to say the responsibility shifts to the buyer of the property?
To the buyer of the property, because he has to deduct the TDS.
Okay, an NRI is selling the property to a resident Indian. How much of TDS he has to deduct depends on the type of property and whether the person who is selling the property is selling it after 2 years or immediately.
Yeah, not the type of property,
Okay.
but the period of your holding. So, you have to give him the details of your original purchase document.
Okay.
So that he can come to a clear understanding whether you are eligible for long term capital gains or for a short term capital gains.
Okay.
Now, if it's a short term capital gains, the tax rate is straight away 30%, which the purchaser will deduct from your sale price.
So, if an NRI sells the property for 1 crore and this property was purchased just a year before, the purchaser, the buyer who is a resident Indian will deduct 30 lakhs as the TDS amount and pays to the government.
Now, because you have put a valuation to the property, I will come to that question later, exactly what will be the amount.
Okay.
Because as your income levels are higher, there is something called surcharge and there is an education cess, even that has to be added.
Okay.
So, if the value of your property is below 50 lakhs, then there is no surcharge applicable. If the value of the property is between 50 lakhs to 1 crore, 10% surcharge is there.
Okay.
1 crore to 2 crores, 15% surcharge. 2 crores to 5 crores, 25% surcharge. Above 5 crores, 37% surcharge.
Okay.
On top of this tax plus surcharge, there is a 4% education cess, which also has to be added.
Okay.
So, to put it in simple terms, if it is 1 crore property, you will be falling into the 50 lakhs to 1 crore surcharge bracket, that is 10%. Your tax liability is 30% because it is within 2 years, 10% surcharge is another 3%, that is 33%, and 4% education cess on 33% is again 1.2 some percentage, will almost become 34.2% if the value is 1 crore of your sale price.
Okay. Now the buyer, when he buys the property, he does a TDS on the transaction value. It has nothing to do
It
with
has
the
nothing to do with your
the
profit.
actual profits made or losses made.
Okay.
If the buyer, the NRI, if he has not made any profits, he need to file the tax returns and make a claim back on that.
For the NRI who is a seller, there is an option given under the Income Tax Act. He can approach through his chartered accountant, the income tax department, and file an application for getting a certificate issued to the extent of tax to be deducted by the buyer.
Okay.
So, the officer will be asking for all your documents, when did you buy, what is the price at which you have bought, how you have made the payment, and so forth, and the tax officer will assess what will be your income tax liability.
Okay.
And he will issue a certificate saying that this is the amount that the buyer should deduct.
Okay.
Now, that procedure takes around 2 months time.
Okay.
So, if you are planning in advance and you are applying to the department, then the buyer may have to deduct the actual tax liability amount as TDS rather than a very high rate which has been prescribed under the law.
Okay. So, to summarize it all, if NRIs are planning to sell their properties, it makes sense for them to plan it in advance, approach your chartered accountants, make your case, get certificate from income tax department, how much could be your tax liability. Once you have this, if you proceed with your sale proceeds, then it becomes easier for you to get less of TDS and less of headaches than to go outright sell and a big chunk of money getting deducted as TDS.
So, I will give an example where if you are selling a developed plot,
Okay.
which you have bought say 5 years back or 7 years back. Now, if a developed plot is sold, and if it is an old plot, if you do not take the benefit of indexation for arriving at the current market price as per the Income Tax Act, then you are allowed to straight away pay 10% as tax liability of the sale value. But if you are selling that plot and you are an NRI and the value of the plot is more than 5 crores, because it is a long term capital gains, your tax rate is 20%, your surcharge is 37% on 20%, which is close to 7.5%, plus your 4% education cess, all put together it works out to close to 28%.
Okay.
Now, your actual tax liability will be 10% plus surcharge plus education cess, which will be roughly around 13%. Instead of that, the buyer will be deducting 28%. Now, that difference of 50% you can only claim back from the income tax department after filing your return and claiming the refund of that amount, and the department may take another year to give you that money back.
Okay.
So, your money may get blocked for as well say 2 years. So, better to take that little extra trouble, go through your chartered accountant and through him file an application, get the exact tax determined and ask the buyer to deduct only that much amount. And once the buyer has the certificate from an income tax department, he is also in a position to deduct that exact amount.
Okay, now let us look at a case scenario wherein which the NRIs does not know what he needs to do. The buyer does not know how much of TDS to be done. Now, if they miss these steps, who is liable? What is the penalties that will follow, or what is the course under the law now if TDS is not done, or if TDS is collected in less than what it should have been collected? How will it get resolved?
See, the responsibility of deducting payment and depositing as TDS is on the buyer.
Okay.
So, if NRI is a seller, what buyer does really does not matter to him. and the law will fall on the buyer's head, and he will be liable to pay TDS with interest and penalty. So, there the NRI's responsibilities are limited, but being aware and following a right system, it always helps. But when NRI himself is a buyer, he has to follow all the steps.
Okay.
Now, NRI can be buying a property from a resident Indian, or he may be buying from some other NRI,
Yes.
where the property is based in India. So, he has to follow both the steps. So, when he is buying a property from a resident Indian, he has to deduct only 0.75%, which is under section 194(1)(a) of the Income Tax Act,
Okay.
and he has to deposit it by a challan to the income tax treasury account. Whereas, if he is buying from an NRI, then he has to deduct the exact tax under section 195, as I have explained earlier, with a much higher slab.
Okay.
So, he should be aware of both the provisions.
Okay. Now, in the event of the buyer did not do the TDS to the required extent, but that does not take away the responsibility of an NRI to pay the proper taxes. TDS is a preventive taxation. Ultimately, the tax liability still remains with the person who is selling this particular property.
So, for that particular financial year, whatever is the profit earned on the sale of property, be it a short term gain or be it a long term gain, he has to file his income tax returns and he has to discharge his taxes. Now, because the buyer has not paid proper TDS, he won't be getting the credit of that.
Yes.
So, he has to pay from his pocket that income tax amount.
So, all in all, it is fair to say that if the buyer has not done the TDS, there is no need for you to celebrate. Your tax liability still stands. You have to file the tax return, and whatever the differential taxes that you have to pay, you are obliged to pay that particular money or face the law.
Yeah, that's right.
Dear viewers, if you thought buying real estate is very simple, it is not so simple. Make your due diligence, research all the things that you need to know, get insights from this episode, and before you sign and proceed with this, know every part of law as well as the due diligence aspect of it. Dear Mr. Mehta, it has been a great experience of knowing the various aspects of buying of real estate in India, the complexities around it, the taxation and other things. Thank you very much for enlightening our viewers on all these aspects. We look forward to have you on our shows many times in the future. Again, a big thank you for you from all of us viewers. Dear viewers, if you think the topic that we discussed today is of value to you and if it has helped you, please like this video. If you are a person who is watching this episode for the first time, or if you are yet to subscribe for this channel, please hit the subscribe button and press the bell icon. Don't forget to share this video with all the friends and relatives. Thank you very much for watching this episode on NRI Money Clinic. I will be back with you with one another episode very, very soon.
Press the bell icon for more details and subscribe our channel.